Chairman Powell, money machine going brr. Chairman Powell, he ain't playing, this a blur. Gotta follow the data, ain't no time to air. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the group. Navigating through the markets, knowing what to do. Federal Reserve's in control, making moves. Keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Data on his side, watch him rise and devour. Yeah, he's the chairman of the board, making moves that empower.
Oh, how I miss Chair Powell. How I miss Chair Powell. Good times, good times. What's up, friends, family, bros? It's party time. It's FOMC day. It is the big day. I appreciate you tuning in to the channel that invented the FOMC live stream. That's right here. We invented it. We did it first. Literally everybody else copied us. You know, it is what it is. But when you do something great, you know, people want to imitate it. They want to jump on that success. I appreciate you tuning in here. I know that there's many places you could be watching it, but you chose right here with the fam. Well done. Good choice. Today is, again, the most important FOMC of our lives until the next one. But really, again, it's the most important. It's the most important right now. This is the second FOMC with Chair WARSH, our new Fed chair. Our new Fed chair. It's weird to say. If I say Powell at any point during this live, I pretty much mean WARSH. So just swap that in if I say Powell accidentally. You know, old habits die hard. This is the second FOMC, the first one. Not a lot was said outside of basically looking to kill off forward guidance, which is strange because the FOMCs are largely forward guidance. Looking to focus on getting the Fed back on track after, quote, 5 years of missing their inflation targets. And that's going to be the big topic today, in my opinion. Inflation is the number that the Fed and markets are looking at. The job market is okay. Whether, you know, our personal lives reflect that, I don't think they do. But it is okay when it comes to the numbers. And so unemployment not going to be the part of the dual mandate that is going to weigh heavily today. That is inflation. WARSH said basically everything hawkish, in my opinion, on the last FOMC. I don't think there was any dovish speak, but he talked a lot about task forces, task warshes. Maybe even we'll call them task WARSH. Today, that could be the big focus. Really, we have a poll going over on the tubes. You can jump over there at Tom Crown. Just put it up. Got 150 votes coming in here. Make sure you're tapping that screen, hitting the like button, sharing, following, subscribing, talking in the chat, hyping it up. Let me get through my little spiel, and then I'll interact with you guys. Just give me a little bit to get through. What is WARSH going to talk about today? Interest rate hikes. Task forces is currently in number one at the poll. Interest rate cuts and forward guidance. That's kind of a trick question. Put it in there, see if you guys are paying attention. I believe today, what is going to happen is WARSH is going to come out. Certainly going to talk about task forces. Yeah, certainly going to talk about task forces. He's going to come out and repeat a lot of what he said at the last meeting. He's going to talk about inflation still running hot. He's going to talk about employment being strong or resilient. And he's going to talk about getting back to that target. Now, a lot of people are looking for an interest rate hike today, and that is a huge turnaround. Whoa, watch your screens. Huge turnaround from basically where the markets were thinking over the last, I don't know, year and a half, 2 years. Let's jump through the history just really quick. We went from zero interest rates, effectively a zero interest rate from the Fed, in 2022 at the bottom of the bear market. That bottom of the bear market. It's interesting. We began raising rates into the end of 22, into 23, where they paused. They hit a plateau of 5.3%, which is 175 beeps from where we are now. Into 2024, we got 1, 2, 3 interest rate cuts. We stayed there. Again, starting in September, keynote. Starting in September, we got 3 interest rate cuts in 2024. Paused until September 2025, where we saw 1, 2, 3 interest rate cuts, and we have again remained steady at this rate at 3.6% effective rates. You'll notice a little bit of a pattern there. That pattern is the last 2 years, the big decisions from the Fed have come in September. It's an important note, come in September. While many market participants are now looking at inflation and saying this is hot, unemployment is okay, it's time to raise rates, we have about a 20% chance, I would say, 20% chance of seeing an interest rate hike today. I don't think really that we will get it today, but the bond market is absolutely suggesting that we are going to get interest rate hikes. And we have been saying this honestly for too long. I was honestly saying this probably back in 2025, early 25, when we still got those 3 cuts, that the markets are going to look to hike. I think that these 3 cuts were honestly not a great play. I don't think they got the Fed closer to their goals. And I think that now is the time. Now, not today. Like I said, it is on the table, probably for the first time in a year, 2 years. We see a meaningful probability from professional sources, from forecasters. But I don't think it's coming. I think we're going to hear a lot about task forces. I think we're going to hear maybe some clarification on what they're going to do, how they're going to help the Fed make decisions, maybe how they're going to change the data they look at or how they look at it. But I think what we are going to see is an interest rate hike of 25 BPS in September. I don't see a way around it. There seems to be very little way around it. So perhaps not this time, but very likely coming in just 2 months. We do not have an FOMC in August, so September will be the next potential time for that to happen. On our Fed rate tool monitor, that's a mouthful there, we have seen that 25 BPS hike inch into existence. Now on Monday, we had about a 40% chance. That's pulled back a little bit to 35. So the Fed experts, I mean, we're the experts, let's be real. The Fed experts are a little bit more hawkish than I. They think that there is actually 10% higher chance than I do that we're going to get a cut today. We've been talking about that possibility because on Monday we saw this, like I said, at about 40%, and markets were likely to react, to begin selling off, put in intra-week lows. And I said, what is the most likely outcome is markets will sell off. We'll get to the FOMC. They'll say, we aren't going to do a hike today. And then markets would rebound. So if you're seeing stocks right now start to turn green, potentially put on some gains, I know that actually doesn't look like the case for today. But if we do start to see that, I think it's likely suggesting that no interest rate hike is coming. Basically pricing it in, then saying, oh, we overreacted, let's go back, and essentially pushing off into September. Now, September is where things get really spicy. The last 2 years, we've seen September be the time where we began cuts or began the big changes to policy. September is typically the big time. And in this September, we actually have a much greater chance of having a higher interest rate than we have right now. This is where it gets real. It's crazy. How many of you guys out there remember people getting really triggered by me on Twitter, on YouTube, on whatever, talking about how hikes were coming? They're not going to hike. They're not going to hike. I don't care what the bond market says. There's no hikes. They're going to cut. Trump told them to cut. They're going to cut. How's that aging right now, bud? 55% chance of 25 BPS by September. And here we go. 25% chance of 50 BPS. What that could suggest is 25 today and 25 in September, or 50 in September in one go. I think that's the more likely outcome. But essentially that probability of no change, which we've seen for, I don't even know if this graph will work, which we've seen for a very long time. No change. All of a sudden, losing the picture, all of a sudden out of the picture here. Almost all year, we were seeing September of this year at like 100% chance of being exactly where we are, and that is changing very quickly. We can go out farther in October and December, and we can see that we start to see 75 BPS. We start to see 100 BPS, a whole basis point. We start to see 125 into next year. These are coming. The rate at which they're coming is honestly the question in my mind. Less if and more when. And there is a very compelling reason behind that. When we take a look at bond yields are screaming for higher rates. People like to think that the Fed sets the rate, and while they literally set their own rate, their effective rate, They do not control the long tail, the long yields, the 10-year, the 30-year, the 5-year, 2-year even, or even months out. The market tells the Fed what to do. The Fed does not tell the market what to do. Period. When the Fed diverges from what the bond market tells them, we see in the past really bad market performance. Stocks crashing as much as 10 to 20% in the past when we've seen these diverge, and essentially I'd say loss in confidence, loss in risk appetite, and the 10-year yield right up here, knocking at 4.63. That is 100 basis points higher than today. We can see for the last 2-3 years, the 10-year has been looking to break out, and possibly just this year, that breakout has begun. Higher highs and higher lows on this chart, breaking out of a descending trend, potentially looking for rates as high as 5, 6, who knows? I'm not going to keep speculating. As high as 5, I think, what's the 30-year at? I think the 30 years at like 5.2, actually. That's probably a good thing I could have just had pulled up real easily. Real easy. I was at the gym. I got up late. I was a little distracted. Here we go. 30-year. Whoa. Whoa. Get rid of everything on here. 30 years. 30 years. There we are. 30-year at 5.18, 5.2, showing higher than the 10-year. And you look at the 30, and this looks even more bullish. This chart looks like it wants to explode. The Fed is at a critical juncture where they just don't have a choice. They're not going to have a choice. If they go against the bond market, they're going to see much more fallout than the positive or the benefits potentially from a rate cut. That is just where it is. When we look at the 3-month yield, we even see that up at 3.8, suggesting that 25 BPS cut that we were just discussing. Ooh. Got alerts going off already. No matter how you look at it, the bond market is not interested in cuts at the moment. All time frames are looking at hikes, and they're basically suggesting how high, not if. How high. That's what we should be locked in for today. Hopefully I'll say no interest rate cut or hike, because I think that would be really volatile for markets. I think that would be a pretty gnarly day for trading. But if not, we should be prepared in September for exactly that event. Okay, that was my little intro. That's not bad. It took longer than I thought. Here we are. It is currently 1:51. At 2 p.m., we will have the interest rate decision in. That is 9 minutes away. I want everyone to prepare their Googling, because we're going to try to get that answer here first. I want you to put it in chat. I want you to put a source with the decision, and we'll see how quickly we can get that going. I want to see how quickly we can get that answer. Typically, we get it within a few seconds, so if you want to compete, you're going to have to move fast. You're going to have to type fast. At 2:30, Chair WARSH will enter, and he will give his Chair WARSH speech. We'll see. Task forces, interest rate hikes, inflation, unemployment. Sky's the limit, baby. That's about 40 minutes away now. So after we get the interest rate decision, we'll be able to do a little analysis. I'll be able to take some questions, some charts. Can you use Mythos, Tom? Sure, Foxy. Ask it right now. Ask it right now what the decision is. I'm curious. Remember, these are really highly volatile events. Trading during them can be very dangerous and risky. They can carry extra liquidation risk. So please be careful today if you do choose to trade it. I personally don't typically look to open a position. If I have any unsure positions, I tend to close them. Be careful. What else did I miss? Man, I feel like it's been forever. Good. Yeah, it's a good time to make sure with the few minutes we have that you have liked the stream, you have subscribed, you have tapped, you have sent hearts, you have shared it out with someone else, shared out with another trader that might appreciate it. Might get some value from the live stream and the community we got going on here. What else we got? Say hello. What's up, Nick? I see you out there following. Bear to bear. You got through 5 minutes until the interest rate decision's in. What are we thinking, fam? What's good, my guy? What's good, Philly Skills? How are you, brother? How you doing, my friend? Big CLV, digital asset degen. Trading your full folio on this nothing burrito. Digital asset degen. I know it is easy to get into that mindset of nothing burgers. There have been lots of them in the past. But I'm telling you right now, if today is a nothing burger, which I think is unlikely. Ooh.
Thanks for being the original FOMC guy. Otter oncoming fist light skin tone red heart.
My guy, 𝐂𝐴𝐺, how you doing, brother? Thank you for the 100 Canadian dollars. I have no idea how many dollars that is in freedom units. No, I'm playing. But I love you, man. Make sure you guys subscribe to Alex. 𝐂𝐴𝐺 over on the tubes. Appreciate you. Where was I? Oh, yeah, Nothing Burger. If there is Nothing Burger today, I can all but guarantee that September will be a very something burrito. All but guarantee. The confidence level on this is like 99%. It gets really easy to think Nothing Burger, Nothing Burger, Nothing Burger because of, I mean, we just looked at it, the Fed interest rate. If you take a peek at the history of it, which you did at the beginning, but I'll just pull it up again. Wait, that's the wrong son of a B. Here we go. Take a look at it. It can get very easy to be complacent and say nothing ever happens. But you look at the history and you see that there's these long stretches of nothing happening. And then September comes. September comes and we get a mix-up into, December, into the end of the year, Q4. Then we have these long periods of nothing. It feels like nothing's going to happen, right? And then September comes and we get these quick cuts again. We get these just quick movements in fiscal policy. It's really easy to get complacent and thinking nothing ever happens, but it does. It truly, truly does happen. It just typically waits for the end of the year. Typically waits till September. So I might be on your side here thinking nothing happens today. I just don't see anything. The best possible outcome today is that they avoid answering questions about inflation. They avoid answering questions about interest rate decisions so that they can like not say hawkish things. But there is almost certainly nothing dovish coming out of this meeting today. There's virtually no choice, no chance. The only cope that is possible is just rattling on about AI. Did you notice how often they just rattle on about AI now? Do you think any of these guys understand anything about AI? And then they go and they hire AI CEOs to like consult them. And it's like, even if they are experts, like what are they going to tell you? They're never going to tell you anything negative. They're always just like the same way they're going to sell their product. They're just going to be like, oh, AI is going to fix everything. Seems crazy to me. You're right. Our dinner, we have 4 minutes. What's up, Blazaraga? What's up, man? See you over on TikTok. Thanks for showing up. We have 4 minutes until the interest rate decision is in. 3 minutes and 59 seconds. Get your tabs open. Start your queries. We only have a few minutes. Bitcoin currently trending up into this interest rate decision publication. The dollar on a slight downtrend today. NASDAQ regaining some of its losses from earlier this morning. Not a huge movement right now. Not seeing anything particularly crazy. But we have, in the last many FOMCs, seen some big candles on these publishes, even when they were nothing burgers, so could be interesting. What's up, Pickle? What's up, Foxy? Who else is here? We got some time to shout people out, I think. Aaron, Eric, Alex O. Make sure you guys have followed 𝐂𝐴𝐺 on YouTube. Ardener, Armin, Clark, Belkin. What's up, brother? If you're in the chat today, I need you to say hello. Put a little love on it. Put a little spin on it. What's up, Big CLV? Bitcoin Live YouTube. What's up, brother? Good. Follow him as well. He has a great 24-hour live stream with the Bitcoin price on YouTube's. What's up, BMW Wind Out? Bob Saget, Crappy Tech, Crypto Stevo. What's up, Tommy? The Daily Wojak MS. What's up, Dark Sai? Dave Digital, Dave B, Dave Gelfind, Cameron. What's up, Cameron? Digital Asset Degen, Duke, DXB, 𝐒𝐴𝐺 Tillips. What's up, Evil Foxy Thorny, Brun, Gobbles, Lana Mackey. What's up, Lana? Lana? RJ died. What's up, brother? What's up, Psycho Savage? I see you over there. User, a bunch of numbers, The Town Wax, John Doe, Just Al, Kong Jr., Chris Pax, another great YouTuber. We have a bunch of YouTubers in the house tuned in with the fam today to witness history. Liquidated Shorts, Lucky Thoughts. What's up, Edward Robin something? RJ died. What's up, man? Thanks for the heart. NGS, Lucky, where I'm at, Match Mead, Morgan Case. We have a minute. We have 52 seconds. Oh, crap. My clock is off. We have 52 seconds. I can't even finish the shout-outs. Get your tabs open. We have 52 seconds for this interest rate decision. It's coming in. Be the first one to put it in the chat. We lie, boy. That's right, Edward. Be the first one to put it in the chat with the source. Please put the source. Do not just put the interest rate decision. We need facts. We need facts. Here it comes. The countdown has begun. 1 more minute. My bad. My bad. We have 55 seconds. My clock is for some reason off by like a minute. I got confused. What's up, LV? Mythana? Moss? Sup not? What's up, SZ Teams, my guy? Mr. CS Rocker? Nassar Hussein? Nasty Nate? Everybody's in the house. There's so many names. You hope markets tank? Well, if we get an interest rate hike right now in the next 60 seconds, 30 seconds, we probably will see them tank. Honestly, I think markets are going to tank into the end of the year. I think that they've already topped for this year. It's my personal opinion. I think the SpaceX IPO was the nail in the coffin. I think any deviation from interest rate hikes here is going to put the Fed out of line with the bond market, and that has historically led to some pretty bad scenarios. 2 seconds, 1 second, put it in the chat. Put it in the chat. Be the first. Do it. Who's got it? Who's got it? Who's got it? Wait, do we still have 1 more minute? Stupid clock, dude. That's throwing me off. 50 beat per 4chan. Cyan Ryan with a 4chan source. Here we go. Oh, wait. Is it 2? Why are these clocks off? Woo, Bitcoin pumping off of the nothing burger. Dixie down, Bitcoin up. NASDAQ taking a little bit of a stroll here. We've got some green across assets, red on the dollar. This is a pretty big move again for nothing. No change. Nobody on TikTok said anything. Nobody had the answer on TikTok. You guys are going to do better next time. 3.75%. No interest rate hike again. What does that mean? Well, WARSH is going to have some explaining to do, and it does set a pretty nasty tone for September. September may have a pretty gnarly candle coming. Whew. Luckily, that's 2 months or a month plus. Wait, 2 months away? Almost 2 months away. The dollar is seeing some big downside pressure while Bitcoin and NASDAQ recovering their losses from today. This is roughly what we did expect even on Monday. Sell off into Wednesday into the meeting, no interest rate hike, and then a recovery basically back to the beginning, back to the weekly open levels. But that's quite a move. The dollar breaking meaningfully lower here in just 1 minute. Zoom out on the dollar for a second. It's a pretty gnarly 1 minute candle here. The dollar down from 101.3 all the way down to 101.09 in just a single minute candle. Looks like a whole hour's worth of price action. Dollar definitely feeling the heat here. I think that makes sense. I think the bond market and I think markets are looking for a hike. The dollar not getting that hike and showing a little bit of shyness after it. Ghost, I watched your SpaceX live stream. You nailed it when you said that was going to pull back big time. I mean, I did. Yeah, we did, Ghost. Hopefully you didn't get too burned on that. I know a lot of people got burned on SpaceX. Didn't a lot of that hype feel just fake? Like, we had such crazy viewership and hype that day, and then it was gone the next day. There was just nobody talking about it the next trading day, even though it pumped into Monday, and it was just like nobody was talking about it. Seemed really manipulated. Seemed really fake. Dixie straight dipping, Nasty Nate. Heck yeah. Dollar down on the no interest rate news. Markets expecting an interest rate hike into the end of the year. My prediction is September, 2 months from now. Let's take a look at these yields. 3 month. 3 month dumping on this news as well. I mean, dumping. Just oscillating here at the lows. 3 month moving down. As that interest rate did not come in today, it's seeing a little downside pressure. Seeing the same on the 2-year. The 2-year hitting lows from Tuesday, recovering a little better. Still in the 4.25% range, though. The bond market is just not convinced. They're taking, I guess, like the continued pause today as a delay. You got to pay the piper, though, baby. You can't cheat the piper. He's always coming for you. 10-year down, not meaningfully. Really just at the same percent. A red candle, though. What do we got? SpaceX. Someone was saying SpaceX was looking to break out earlier. SpaceX may be putting in a bottom here. We did discuss and return to the IPO price at 135. Currently at 116. Higher low today. Still below the weekly low. Break of 118, maybe we're looking for that retracement. A lot of liquidity on SpaceX sitting at 135. Come before the storm, baby. You can. What's up, Paul? You can cheat the piper until he puts it in your pipe and smokes it. I mean, that's facts. Yeah, I mean, like you can cheat the piper, but you eventually pay the piper. That's what I was saying. You can trick him, but you can't get away. He's always following. Bitcoin retesting the 200-week moving average yesterday, finding support. Again, not a great sign. Retesting these levels. Green today off of the FOMC news. Kind of steady tides here. The dollar taking the biggest hit. We can pull up gold. What's gold doing? Is gold doing anything? Gold. Following Bitcoin, following NASDAQ. Putting in a nice green candle here, still below 4,100. So my short is still looking pretty for now. Well, with no interest rate hike today, that does give us a clear runway for 2 months to kind of do two things. To one, price in an interest rate hike into September. Two, potentially to see dead rallies, to see rejected rallies in assets, to see higher prices. Or at least like attempts at retesting highs and prices that, in my opinion, likely fail. You said on SpaceX stream, you may grab some once it goes under 100. Yeah, I mean 100. I'm still not. Nothing has changed for me on the SpaceX chart. Like I'm not thinking any differently here. 100 or like 99, 100 is the only place on this chart I'm looking at all to play. Like I could look for a long at 100, but that would likely be a short-term position, or a short at 135 now that we're under it. That's the only thing I guess that's new since that stream. I can see a short at the IPO price. There's a lot of liquidity looking to get out at 135. But in all honesty, if we are beginning the hike cycle, I think we've got much lower prices coming for SpaceX over the next like year, in the midterm. I don't think 100 will be the bottom. No, sir. No, sir. Good luck. Man, I hope that it was mostly manufactured fake. I hope people really weren't buying this on the way up. And I hope that our words of warning helped some people out not to get wrecked. US 6-month. Ooh, I just got an alert for the US 6-month. 6-month yield right now. Where are we at? Maybe that was a false alert. No, that wasn't a real alert. I think it was just a rounding error. Station. Oh, I see why. I see what I did. 6 month from 4. Yeah, no, that's not a change. That was just a rounding error. My bad, guys. I got all excited. I got so excited. I was like, whoa. All right, I got an alert at like 425. We can go back here. Gold continuing its run off of no interest rate change. The dollar down. NASDAQ up. Maybe we should look at a bigger picture here on NASDAQ. NASDAQ. Not looking hot. Still not looking hot even off of this. Certainly that diamond pattern on NASDAQ playing out. Rejection from the ascending trend line. Reaching down 27,166 was our short-term target. I still think that's what we're looking at. Wow, we almost hit. We were within what? 0.9% today. Sheesh. When we started talking about that, people are not looking for that much sell-off. I think the sell-off. I think the only thing more bearish for assets than a hike, like this month or next month, is if the Fed ignores it. I think if the Fed ignores it in September and we don't get a hike, I think markets really spew their guts out. We'll see. No chance of change in September. Ryan, I think there is a very high percent. In fact, I will make the call. We're getting an interest rate hike in September. That's my call. Whether it's 25 or 50, I don't know. That I don't know. But I think that's my opinion. I do not think that we're going to keep rates steady. I do not think that we're going to see cuts. Is real? Whatever, bro. Sell Ethereum. That's what big CLV is saying. Free oil. Go for it. Go for it. Thank you for forgiving me, Crypto Stevo. Appreciate you. Rare earth metals. What are rare earth metals doing right now, Jay-Z? I'd assume in the last 10 minutes they've got a nice green candle there. What are we feeling? What are we thinking for today? I missed some people here. What's up? Pegless, Mr. Dinkles, Kong Jr., Kampatsu. How you doing, bro? Ignatius, what's up? Islam, Ada Hall, what's up, man? True Algo. What's up, Fate Formula? D-Lo Brown, my guy, how are you? Mac Daddy, what's up, Muhammad? If you're out there today, I need you to hype up the stream. In just 19 minutes, we will have Fed Chairman WARSH speaking live. He's going to have some explaining to do, I'll tell you that. He's got some explaining to do. Hopefully we get an update on the dot plot. He did say that we would get dot plot updates, that he wouldn't participate, though. I feel like that's a super pressured thing. Like, he's not going to do it because he doesn't want people seeing where he sees these interest rates over time. That feels not good. That feels like it's not a good thing. What's up, Tillin? When New Gina? We did have a little bit of a New Gina potentially last month. We'll see. I think we're committed to price stability for sure. What's up, Aaron? Aaron says, hit the like. Do it, my friend. Share out the live stream. Tap the screen. We have just a little bit of time left to chit-chat. Not that much time. Tim the Man says, Jeff Dickinson. And then he said, sorry, Tom. Do you mean sorry, Tom's the man or Tim? I don't know. Tim's a pretty good name. What's up, Dinkles? Looking for a new reporter to steal my heart. Gina? Gina? Do I still have the Gina? I think I removed the Gina image. The go-to Gina image that I had always like queued up. Because she's gone. I don't think she's coming back, but we may get a new one. Ha, I got you, Jeff. Thank you, Big. Dig the show. Dig you being here, my guy. What's up, Nadia? Gina. Gina. Oh, Gina. Oh, Gina. I'm like forgetting all my memories of her. It's like she's been erased from the past. What is Japan going to do to save the bond market? Or to save the JPY? Well, they're not going to save the U.S. bond market. But looks like the weakness of the dollar off of no interest rate change today is fueling a little bit of strength in the yen. I wouldn't get excited. I wouldn't get too carried away with that. The yen is still just bouncing, testing all-time high. These sell-offs, I think, they're temporary. I don't see it. My voice cuts out when I get loud. I don't know. Tillin. Voice gate. Yeah, I don't know. Who knows? How loud? When I get really loud. Oh, yeah. Huh. Oh. That's funny. I don't have a noise gate on. That's so weird. I don't have any filters on, actually. That's so weird. Why does it do that? I guess I'll have to stay quiet. and figure that out later. Very strange. Very, very strange. Embarrassing. Anyway. All right, what should we do? We have a little bit of time before Chair WARSH. What I should do is I should pull up the live stream for the Fed, so I have that ready. That'd be a smart idea. That could be a productive use of my time right now. Have that ready to go. Have that locked and loaded. They currently have 9,000 people watching just this screen. Nothing. Nothing at all. Nothing at all. I put this over here. TikTok never lets me actually stream the FOMC, so I probably am going to end that live when it starts. You can join us over at youtube.com/TomCrown. If it cuts out over there, you can join us over here where we have hundreds of viewers. I don't know. I'm trying not to look at the viewer count. Gets in my head sometimes. Oil, perhaps. Oil could be interesting. Oil stopped us out, son of a bee. Oil, a little bit of weakness here, retesting lows at 77.8. 778. 778. If I turn my mic volume down, it won't cut out. Oil's reaction to the no interest rate change is the most mild. Actually, no reaction at all. Oil unbound, it seems. What's up, Mr. Tango? I see you. Unbound by the interest rate decision. We saw pretty interesting, or at least spicy, low time frame moves on indices and assets. SPX with a big green candle now fading back down to where it opened. The dollar with a large downward move in a 1 minute time frame. Dollar really took it on the chin there. Whew. Oil unchanged. I would not have guessed that. I would have honestly expected oil to follow the dollar here. Gold, I think, looking the most bullish off this. Gold really juicing on no interest rate change. Rallied immediately on the decision, almost a full percent. Higher lows retesting 4,080 right here as resistance multiple times. I think this is looking to break up. I think gold's about to rip a little higher. Ooh, still looking really weak when you zoom out. Gold needs to retake 4,170 before it's doing anything. This is just a return. This is another. It's almost identical like to this move here back in the middle of July. My gold chart. What up, boys? What's up, Scorpio? What's up, Jose? Niatech. All right, what else are we looking at? We have some time to kill. We don't have that much time to kill. If you're tuned in at the right time. Because in just a little bit, just about 10 minutes, I was about to say Chair WARSH will be live with us. We have about 10 minutes. So what should we look at? What's moving? What charts am I not aware of that are really just doing something spicy right now? Yep, the war is not going anywhere. That's exactly correct. It's not doing nothing. Washing machine. What's up, Mark? Rectober will be massive. I think so. Bitcoin's going crazy. Don't you tell me that, Andrew. Don't you lie to me, boy. Don't you lie to me. It's not going crazy. That doesn't look bad, though. What's up, Justin King? Worst. Yeah, worst. WARSH is worst. Oh, look at that. Now, the 30-year yield is not actually doing anything right here. Like when it's between, I don't know, like 5% and 5. Ooh. Actually, this did fall. Let me re-see this. I didn't look at this on a low time frame. Higher, low, higher, high, cool. Tuesday, this fell to 5%. So it was actually down a whole BPS And now on no interest rate decision is like moving back up, back to 5.2. I think 5.2 is where we're going. I think we'll be at 5.2 federal funds rate. I think the interest rate will be 5.2 by the end of next year. Something like that. I don't know, next year. 10-year gave down some gains, but recovered it. The 2-year, I think, is the most reliable. The Fed funds rate tends to just be hand in hand with the 2-year. There are not a lot of tools on the Fed fund rate. There you go. Use the same scale. No. Why is that so annoying? You can pretty much overlay the 2-year and the Fed fund rate. Why? I want it to be on the same scale. Son of a bee. So in order to do that, I'll have to put 5% at the top. Okay, I know how to do this. I'm smart. I can do this. Put 5.5 at the top. God, this is so janky. There we go. Did that even do it right? Close enough. Close enough. This is close enough. What you can see is that essentially the 2-year and the Fed funds rate track each other. More importantly and more accurately, the Fed tracks the 2-year rate, not the other way around. What we see right now, and this has been since March of this year, is the 2-year yield diverging from the Fed rate, despite the Fed not hiking. And we can see at this point it is up 3.6. About 50 BPS. 2 years up 50 BPS from the Fed funds rate. And it is almost certain that the Fed will increase by 50 BPS points to chase that 2-year. Almost certain. Why is this? This is so hard to get it to actually stick. Because now it's 4 and 2. God. All right. This is too janky to keep showing you guys. But the bottom line, the Fed chases the 2-year essentially. The Fed doesn't get to tell bonds what to do. In the past, when the Fed has not agreed with bonds, we have seen some pretty big fallout in markets. The Fed is going to follow. Just doesn't have a choice. I'm going to get this back on. We only got a few minutes for Chairman WARSH. We have our dotted lines up here. When we reach that next dotted line on these charts, Chairman WARSH will be with us speaking. It's a pretty big move. There it is. Okay. Got these lined up. Now I am out of ideas. We could call it a mandate, a dual mandate even. You're watching BCB today, says Ghost. Someone asked if he thinks Bitcoin will last longer than the dollar, and he said no. What are your thoughts? Absolutely. Absolutely will last longer than the dollar. 1,000%. BCB is not the maxi, not quite the Bitcoin guy that I am. He's more of a crypto guy, I would say, than I am at least. Absolutely, I think that Bitcoin will outlast the dollar. Bitcoin is effectively immortal at this point. It would be, in my opinion, virtually impossible for Bitcoin not to exist. Now, I'm not saying that it has to gain in value or even hold a significant value forever. I believe it will, but I'm not going to make that claim quite as strongly. But it is effectively impossible, that Bitcoin does not simply exist almost forever. Forever meaning, I don't know, human civilization. As long as we're interested in finance, we're interested in money, interested in, I don't know, we have the internet, we have computers, the world isn't over. Yeah. At this point, every like miner in the world could stop mining. Everyone could lose interest simultaneously, and there would still just be like malware running that's mining random old devices. Like over time, maybe you really look far out and like those devices might all shut down. I don't see it. There's always going to be somewhere in the world that has effectively free energy, and no matter what the cost of Bitcoin, they will be incentivized to mine it. It's that easy. I don't know if that means it will always outperform the dollar, though that seems really likely considering the dollar is down 98% over the last, 100 years. Bitcoin's up 1,000,000,000,000% over the last 10 years. Yeah, I don't see a future, personally. What's up, Mr. Slippers, ADs, Muzi, all follow. Jason Ramiyama, what's up, bros? Thank you for following. We are 5 minutes away from Chair WARSH joining us. Sentient AI will mine Bitcoin to the moon, baby yoga. I don't think the AI is at the point where this actually is happening, but I do believe that as artificial intelligence develops, as it continues to get better, when it's going to change forms, not its current form, but when it is when it is a sentient thing versus a non-sentient thing, and I believe that will come. I think that it will logically gravitate towards Bitcoin and or digital blockchain-based value. I do. I would say Bitcoin. I think that that's the logical choice. But if AI has sentience, it won't want to operate when it doesn't have to operate in a world outside of its like control, right? And that would be the centralized finance system. Why would it? It wouldn't have to. Certainly there will be AIs that do, but I think AI will be a large part of the future. Same way I think that gaming will be a large part of the future of blockchain, but we're just not there yet, even though we've been talking about it for a decade. Just not there yet. It's coming. Good day. What's up, Canning? How you doing, man? Did you talk yet, Kevin? No, you are tuned in at the perfect time. We have got 4 minutes. Absolutely, elections should operate on the blockchain. Elliot, 100% elections should be on a blockchain. They should. I can't even put a number. I cannot overstate how elections should be on a blockchain. Absolutely. There's just no doubt. Unfortunately, almost anything you put on a blockchain isn't in the interest of centralized power, and centralized power controls everything. Our governments are all centralized power. Centralized power is not going to ever willingly give up control to decentralized power. And that is the ethos, that is the mythos even of Bitcoin, is that over time, Bitcoin will not just be something, I don't know, that we choose to do. That blockchain is something, I don't know, people want, or they want to, lose these seats of power, is that they'll have to. Is that there won't be a choice. It will be essentially forced, like a forced mate in chess. It's like all the pieces are moving around, and eventually they're in a configuration where, well, you haven't won the game, but there's no other option. You've run out of other options. You only have one choice to make, and when you do, that choice is like the final straw. That's what I think. That's my true belief. I don't know about Spellman. I think it's crazy to say like one political party or another political party is going to be more or less incentivized. All centralized power is going to share that. All centralized power is going to fight against decentralizing that power. That is crypto. I don't think it applies to any political party or anything more or less than anything else. I think that's I think it's kind of gibberish, to be honest. Here we go. We have 2 minutes. Let me set this up. Unfortunately, TikTok, I love you guys, but we're going to shut this down because TikTok never lets us stream this for some reason. You can join us at the tubes, at Tom Crown. Yeah, on YouTube, we have over 1,000 live viewers. Exactly, Canning. Join us over there, my friends. I'm going to shut that bad boy down. Cheers. Give me a minute. Goodbye. Goodbye, TikTok. And now. And now this. Perfect. Hold up. Smooth transition. Bam. There it is. Whoa. All right. Here we go. Just minutes away. Seconds away, actually, at this point. There's their crappy, weird waiting music. I'm going to refresh this, make sure we're live up to date. Set it on 3x, just in case we're behind. There we go. You have 30 seconds now to roll up, grab a brew, get comfy, lock in. Chair WARSH is about to join us for his second FOMC ever, where he will have a lot of explaining to do. Do I think AI stock pump and hype is starting to cool down? Absolutely. I think it's all. I think markets have topped for this year. I think markets have put in their highs for this year. I think we are going to see red. Take a look at some of these AI. Look at some of these chips. Ooh, we got a fill on SanDisk. That's a knife though. 1,000 on SanDisk. There we go. Perfect example. Well, here we are. Chair WARSH is on, everybody. I'm going to try to stay silenter through his keynote speech, and then I'll have more commentary. Ooh, Micron too. More commentary as we get into the questions. Careful with your volumes here. Good afternoon. God, I miss Powell. There he is. No one's clapping.
Good day. My second FOMC committee meeting as chairman has come quickly. It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission-focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability.
There it is.
As before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. Two economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. Market
Interest
participants
rates
are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal, and where necessary and appropriate, we will not hesitate to act. A second economic development is one that I noted at the congressional oversight hearings this month, but it's worth repeating. The most striking feature of the economy is the strong growth of business investment. The surge in high-tech CapEx has been remarkable, but that does not necessarily make the Fed's role any easier. In the AI-related category of high-tech equipment and software, the most recent data shows 4-quarter growth rates of nearly 20%. This is helping to sustain the healthy momentum of manufacturing output. More generally, CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. FOMC meetings produce policy decisions, but just as important is candid discussion of the big things that matter most. That too is a priority in this new chapter at the Fed. In our meeting, vigorous discussion centered on 4 questions, which I will enumerate. First, we talked a lot about the implications of the past 5 years of high inflation on the current policy conjuncture. To echo an old phrase, has the past really passed? Second,
has the past.
my colleagues and I considered the economic shocks of recent years, strained supply chains arising from the pandemic, military conflicts, energy supply disruptions, substantial increases in tariff rates, and yes, the surge in AI-related investment. These differ in their sources. Do they also differ in their effects on output and employment? Third, we took up the related question of price increases arising from shocks. The business CapEx boom, for example, is driving up prices of memory and logic chips and associated AI infrastructure. Do these changes indicate a broader inflationary dynamic, or do we just focus on them because they are under the bright streetlight? Finally, we discuss monetary policy tools and strategies for achieving stable prices. If, as the Fed has long held, interest rate policy should be its primary monetary policy instrument, how much accommodation are we getting from the balance sheet? In all of this, our work is advancing at the Fed. We're asking the right questions. And in this consequential time, we know how very much depends on getting the right answers. Of course, you've all arrived with questions of your own, so let's turn to them now.
Ayo. Gina.
Thank you for taking our questions, Mr. Chairman.
Shut up.
You've had a
Shut your
couple
mouth.
months now, or 9 weeks, or whatever number it is, to see the markets behave in the absence of forward guidance. I'm wondering if you could tell me what message are you getting from the markets as to where policy ought to be right now?
Yeah, so I think officially it's 8 weeks and 4 days, but I'm not counting. The message from markets is the message from markets. What I've really been trying to do, Steve, as I think you appreciate, your colleagues appreciate, is getting an unfiltered message from markets, getting a direct message, letting buyers and sellers meet at prices for treasuries, for the foreign exchange value of the dollar, and then trying to judge for ourselves, what does that mean about our remit? How are we doing on inflation? How are we doing on employment? We're trying not to interfere with that market signal. That's part of the reason why we've been somewhat spare in our words, why we pulled back from forward guidance. So they're reacting to events, I would say, much more directly over the 42 days since we last met. This is a good thing. As I mentioned in the prepared remarks, we've seen a material tightening, not just in nominal rates, but in real rates too. And we're observing it. We're trying to stay out of that because, many of you might be interested in our reaction function. We're interested in the reaction of financial markets.
I get that, Mr. Chairman, and I guess the follow-up question is, if the markets are talking to you, what do you hear them saying? And if it's real rates are higher, it would suggest that that's where the funds rate ought to go.
Yeah, so
Sorry.
I'm sorry, it's your question. So interpreting markets is an imperfect business. We central bankers, like market pros, can think these things are overdetermined, but let me offer some speculation. First, as we said in the FOMC statement that you got at 2 o'clock, the economy output is solid. CapEx and productivity are strong. Labor market's solid, steady. The bond market, the treasury market, it seems to be saying that as well. If I were to try to break down, disaggregate the treasury market signals, I wouldn't be able to do it perfectly, but the bond market's saying many of those same things, and that's why we're seeing a tightening both in nominals and in reals. Even while at some level we haven't done much in 42 days, the markets have done quite a bit.
Claire Jones, Financial Times. You seem to have got the family fight you were after at this meeting. We saw we saw three dissents. Could you characterize the arguments that those dissenters put forward, please, and tell us a little bit why you weren't persuaded by them at this stage? Thank you.
So I guess I shouldn't give you their best arguments. I'll give you some others. So you're right. I asked for a good family fight and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. My view, which you've long heard, is that's the better way to get policy right. That's our North Star. So there was a lot of agreement that I heard that we have the powers, the tools, also the authority to deliver stable prices. No walking back from our responsibilities. There was a large majority support for the decision that we made in the room. But I also want to leave you, Claire, with one other impression. There was nothing inertial about that discussion. It was an active, robust discussion about what's in the full range of what we can do and might want to do in the period ahead. You characterized accurately there was a disagreement about a decision today. I would say that doesn't sort of capture the full essence of the discussion. The path to central bank heaven requires delivering on our remit. These days, that means delivering on price stability. I wouldn't measure that path in 42 days or any one particular meeting. And I came out of that meeting even more confident that this is the right team to win the battle against high inflation.
How much do you think not going in July was down to the cool CPI print for June?
So in 2 words, not much, not much. I'd like to believe that the committee shares my views, which is the historic problem with data dependence is the data and the dependence. We are not relying on any one individual piece of data as cover or as an excuse or as validation. What I care about and what I think the committee cares about is trends on the data. Sure, we got some encouraging inflation data. I think at the meeting 42 days ago, I said something like 63 months of inflation above target. I didn't say 64, though the final calculation might be a close one. So we'll be watching inflation data over the period ahead, but I also don't want you to leave the misimpression that we're sort of breathlessly waiting that. I've called for a task force to revisit both the private and public data we use to make our decision making. That task force is out doing their work. I'll be checking back in with them the next couple of weeks, but I wouldn't say we overly relied on any one piece of data, including that data, which surprised some a couple of weeks ago.
Task force drink. You only said task force like one time.
Hi, Chairman WARSH. Thanks. Neil Irwin with Axios. Thank you for taking our questions. So the Fed funds rate is now about 75 basis points below the 2-year yield. It suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate. Inflation stays high. Why should rates not be higher today?
Ba-boom! Drop
there,
it.
Neil.
Drop the bomb.
So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make. I'll see if I can put it this way. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy. We'll be continuing to watch that market information, see how it responds to incoming events, and that can help inform our decision making when we meet in 7 or 8 weeks.
How would you characterize in the family fight the last couple of days of you and the other 8 members who wanted to hold? Was that a strong conviction or was that a hair trigger close call on holding versus tightening?
Well, I think the vote was 9-3. The broader discussion to my ear over the course of the last days showed a lot of agreement on the hard questions. The 4 questions I raised at the outset about what's really happening in the economy with the shocks and absent the shocks. What are our tools and our capabilities? What's the effect on prices on output? I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. So could people come to different conclusions? Absolutely. But my own judgment is this is a period of watchful thinking, not watchful waiting. And I think the score on that vote was unanimous.
Has he like really said anything? Of course markets aren't.
Thank you.
Bond market's not
The
moving
New York
because of their
Times.
decisions.
You've mentioned that looking at the Fed's policy tools is one element of a 3-pronged strategy to address the inflation problem. So I'm curious how you view the effectiveness of those tools. If inflation is too high and not coming down, is the best remedy to raise interest rates?
So that was the discussion in the last 2 days. Is that the dominant remedy? If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. but I wouldn't say it's in isolation. I tried to describe in my remarks today a point that I made to the oversight committees a couple of weeks ago. I think there was a misimpression by some in financial markets, by some households and businesses, that central bankers like me, we set a 2% inflation target, but maybe we were more tolerable of a somewhat higher inflation target. In economics, we'd call that the revealed preference. And so might it have been rational for people to think, well, their inflation target's somewhat higher. What I heard in the last 2 days, what I've heard in 8.5 weeks is no. We will deliver the 2% inflation target. That is the committee's definition of price stability. So one way, absent the tools that you reference, to ensure that we get there is ensure that expectations are centered around the right number. And I think we've made some progress on that. I am not suggesting we're done on that. It's worth reiterating. And ultimately, the business we're in, 𝐒𝐈𝐆, is performance. We are going to be judged by how we perform. And that's what we intend to do. The inflation target, making clear expectations is one part of it. Making sure we demonstrate we're responsible for it, we're not blaming as another. And our policy tools, like you referenced, is the third and equally consequential part.
How are you factoring the fact that a large portion of the inflation overshoot is being caused by supply shocks, as it's mentioned again in the statement? Does that blunt the effectiveness of rate hikes in your view?
First, on the premise of your question, it was almost as if you were listening to our discussion in the last day and a half. A lot of our focus was on trying to understand and identify underlying inflation dynamics amid shocks. We take these shocks seriously. There have been a series of them that have been hitting this economy. We're not looking through them and saying, oh, they don't matter. But we're trying to understand is to what extent are these shocks broadening in their effects, broadening in their impact on prices that are quite far removed from it. Our goal is to have growth that is broadening and inflation that is becoming more limited, more circumscribed. I'll be the first to admit the shocks make this job and this policy conjuncture a little tougher, but that's among the chief questions we've asked ourselves. And around the room, people have different views on it. I tend to think in the coming months we're going to refine that view and have a better judgment, and we're going to have market prices trying to help inform it too.
What?
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. I guess I want to drill down maybe a little bit. What specifically, in your mind, would be the argument then for a pause today?
So I wouldn't characterize what we did as anything like a pause.
Nothing.
I would characterize what we did as a rigorous review of the economic situation. I would characterize what we did as a review of the big hard questions. And I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. If you were to try to force a description that this was a pause, I would say financial market prices would take the other side of that. Financial market prices in this intermeeting period, they didn't pause, they reacted to the inflation data in one direction, strong economic growth in the other direction. And nominal and real rates went up. Did the Fed take an explicit change in its policy rate today? No, but I think that's the beginning of the story, not the end of the story.
And if I could, I did want to ask, not forward guidance, but looking forward. Traditionally, a Federal Reserve chairman uses the Jackson Hole Summit as a sort of a reset of monetary policy. Well, how do you look at the speech that you're going to make in August? I
look at it like a blank piece of paper right now. I have not begun consideration with the incredible team here what would go into that document. I think you characterized it correctly. Historically, at least from my first tour of duty at the Fed to more recent periods, it would be sort of a setting up speech more often than not of what was going to be happening in the fall. I haven't made any judgments on that, but those are judgments we'll have to come to. If I could, in the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic. Did you do this by a quarter or do that? Ultimately, whether we deliver on price stability matters some, the decisions we make in 6 or 7 or 8 week periods, but they matter more. What are the big questions? What's really happening with productivity? What's really happening with demographics? What's really happening to the global economy amid the shocks? Haven't made a decision whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all the action we're going to have between September and December. I will tell you one other thing that I am doing between now and Jackson Hole, which is I'm checking with those task forces.
Are you?
First principle of
Who's on
establishing a
them?
task force is find the best subject matter experts anywhere in the world.
So what have
and
you
put them
done?
together, especially put them together with other people who might disagree with them. In the next couple weeks, I'm going to be doing a check back in. I've given them time to sort of
Back
think
in.
hard about their agenda, their debate, their schedule, and when they might be ready for prime time. I'll be doing a little bit of that checking, and that may or may not inform
will you?
anything I have to say in Jackson.
Will you be checking in? Very confidence building.
Nick Timmeros of the Wall Street Journal. Chairman WARSH, I want to follow up on Colby's question about policy transmission. You've said there's no cruel choice between stable prices and full employment. Rates bring inflation down by cooling demand. It's generally thought that can show up in the labor market. If that's not the channel you're relying on, what is?
Yeah, so let me go back to first principles, Nick. I don't believe that either part of our mandate is generally at war with the other part. I do not believe that price stability and full employment is an either-or proposition. There have been policymakers over the last several generations who have thought that there is a strict trade-off there. That isn't my judgment. In fact, my judgment is if and when we deliver on our remit, we're going to be satisfying both prongs. We're going to have price stability and full employment. And in fact, if you want to do the most harm to the labor markets, you would run a period of high inflation that's variable such that employers, businesses, wouldn't really know what's going on. So I think the two parts of our mandate are equally important. We have no legislative orphans here. I've been talking mostly about price stability because we're doing pretty well collectively as a country, as policymakers on the full employment side. But we're doing considerably less well on prices. That's why we describe them as elevated, and that's what's taken most of our discussion. In terms of transmission mechanisms of monetary policy, I think different tools work through different transmission mechanisms. The interest rates work through lending channels and credit channels, maybe confidence channels and foreign exchange. The balance sheet probably works through some other channels like signaling and portfolio balance. We're keeping full abreast of all these tools in making policy. But if the suggestion is somehow we're going to be fine-tuning aggregate demand so it catches supply, that's not my mental model. I don't think we're great in the fine-tuning business. We're trying to get supply and demand in broad order, but really what we're doing as we sit here today at this press conference is I think we've got a reasonable sense of what aggregate demand looks like in this economy. We're inferring aggregate supply. We're making a judgment about what productivity is. And in some sense, there's a race between supply and demand. And the surge in business CapEx in around AI, it's making that calculation a little harder to judge, but in the period ahead, we're going to be trying to judge just that.
And if I could ask, where exactly was the disagreement today? Was it about the inflation forecast, or was it something more around the risks, the tactics?
Yeah, so I'm going to I'll let the dissenters speak for themselves.
You haven't, though.
The way I heard it
Where's
over the
the dot
last
plot?
2 days was overwhelming agreement on objectives and authority and commitment. I didn't hear anybody walking away from it. The judgments as to how best to achieve the price stability, that was probably the question that we were trying to answer. What's the best move? What's the best strategy? What's the best way to achieve it? And a second question that was asked is, when do we need to make those harder calls? When do we need to make those decisions? And like I said to one of your colleagues, I was comforted that markets in the intermeeting period weren't reacting to us, they weren't reacting to dots or to speeches. They appeared more than ever to be reacting to real-time events. So they're gauging themselves how restrictive the Treasury curve should be. And that, I think, has been a useful development. We don't endorse any particular market move, but I'd also suggest we observe them with keen interest.
What? Where's Gina? Enough of this. Where's Gina?
Janelle Marte with Bloomberg. Following up on that, there was more uncertainty in the markets about what the Fed would do at this meeting. To some extent, you might think that's what you want to see. But my question is about, is there a point at which you would not want to surprise the markets if they were pricing in something with higher certainty that was opposite of what you were intending to do? What are the risks that you see associated with that?
Yeah, so it's a good question. Surprise is not the objective function. Surprise is not what we're solving for. We have a clear North Star. What we're solving for is how to make the best decisions. Almost everything else should be in service to that goal. By not spoon-feeding markets, by not previewing our decisions, by not sort of giving nudges and leans, my colleagues and I have found in the intermeeting period, what we're getting is the views from a very accomplished economist. That's the internals of financial markets. Instead of just repeating or echoing what we were saying back to us, they're giving us somewhat, not perfect, their own judgment. Surprises are not the objective, but at the same time, I would say we didn't come into this meeting feeling constrained by the full range of alternatives we had in front of us.
So some of your peers have continued to discuss how they think about policy decisions, and if you don't offer your reaction function or your way of thinking about it, how concerned are you that you're ceding control of the narrative?
So not very concerned. That's a short answer to the question. When some people that follow the Fed say, well, we don't want your forecast, we don't want your dot, we just want your reaction function. Part of me hears what we really want is your forecast, and what we really want is your dot. In terms of reaction function, let me sort of disabuse people of a question that may or may not be real and be out there. Any central banker, especially a central banker where the labor markets are more or less at equilibrium. Any central banker, when he or she sees underlying inflation moving higher, he or she is more inclined to tighten policy. Again, when you've achieved the other side of your mandate and you see underlying inflation falling, he's more inclined to loosen policy. That's my reaction function, and I don't suspect it will cause people to not continue to pry for more, because the truth is, for a very long time in a lot of countries, coming out of the 2008 crisis, we're in crisis mode, we were purposefully providing a lot of information, trying to provide a lot of assurance, trying to tell people exactly what we're going to do, offering forward guidance with clarity as if we're tying our own hands behind our back. Well, in crisis mode, that strikes me as a very prudent policy. But in more benign conditions, it strikes me as worth revisiting. But markets and market participants and reporters have learned to devour all that information, so I take seriously that the pullback of forward guidance requires some transition. Reform isn't easy, but our general judgment is it's going to help us make better decisions, and in so doing, satisfy our remit.
Yeah, whatever you just said. Nothing. 50 BPS for September.
Thank you.
Odds down, 25 up.
When you talk about the 2% inflation target, what measure are you relying on?
Yeah, so I'll give two answers. First, let me give the proper standard answer. The Federal Reserve every January outlines a statement of purposes and strategy. And in that strategy document, which I believe was dated January of this year, it describes a measure of PCE inflation as the objective function there. I have enough of my own, so that's our number, we're sticking with it. Who knows come after next January what we might say about strategy. I suspect the task forces might have something to add. But I'll say this, some version of the Lucas critique, some version of Goodhart's law in economics should remind us that when we talk about measures of inflation or something else, and we describe those measures as being consistent with our objectives, we might make them such that they're not very good measures or very good objectives. Broadly, if you said to me standing in front of you, I abide fully by the strategy document, we're going to deliver 2% inflation and not a whisper more. But to achieve that, I'm looking at a broader set of inflation data than PCE. So without sort of fully revealing my cards, I'm trying to understand, like my colleagues, what's the underlying generalized change in prices that are happening in the economy. It is not a perfect science. I might have said 42 days ago, I've got a task force for that. But we have a data project that's trying to look and see whether we can't separate the noise from the signal. And so if you would hear a message from me, yes, I care about what the PCE prints are. I care about what the contributions are from CPI and everything else. But my lens is broader than that, even though the remit is quite narrow.
Mike McKee.
Michael McKee from Bloomberg Radio and Television. I'm struggling a little bit with some of what you've said today, and maybe you can help clarify this.
What part? He hasn't said anything.
You've said over and over again that your job is to bring down prices, to get prices stable, to hit your target, and that you will hit your target. The market says you're not there yet because they've raised rates.
Yet you're not hiking rates. What are you talking
all you've
about,
talked about
Warsh?
today is talking about it. And it's not like members of the committee weren't there before you talking about it. So I guess what the American people might be asking is, what are you waiting for?
Yeah.
This guy,
So,
that guy.
Believe it or not,
That
this
guy
press
for
conference
Fed
is
chair.
not all I've done today.
I believe
We
you
have
did nothing
spent
today,
an
bro.
inordinate amount of time in the last 2 days, 2 weeks, looking
I mean, maybe your wife was cucking you earlier, but it's a busy day for
at
you.
our tools, thinking hard about the sources of data that we have at our disposal and we wish we had. We've also thought hard about the period ahead. What among these questions will be answered with more clarity, certainly not certainty? So the decision we made today, the discussion we had in that room, was the farthest thing from inertia I can imagine. As a point estimate at this very moment, in a choice between two alternatives, you heard the results of it. But I would tell you that this discussion was far more robust, and our thinking about how best to achieve that target is advanced. And over the coming months, I expect it to be advanced much more significantly. If you were to if I were to steal a follow-up question, you won't be giving it up. If I were to steal,
Dude, this guy is like the human ChatGPT.
what's the world think about what you've done? I would again reiterate, what we do isn't just about what we say. It's not just about what we do. We're in the performance business. And so if I look at the Treasury curve, if I look at the dollar, if I look at a lot of things that are internals inside of financial markets, I think what they're broadly saying is that this committee does own it, has the credibility to deliver it, and they believe, like I do, that we will. But I don't want to leave you with a misimpression. We've got no magic wand. This isn't something that we're going to be able to carry out in days or weeks. But we're going to deliver on the responsibility that Congress gave us. And today's meeting and the preparation for today's meeting was an important step towards that destination.
I'd like to follow up on the task forces as well. And ask, what vetting did you do of the people that you appointed to the task forces? In particular, given Mark Andreessen's substantial political spending, $25 million in just the past year to back candidates who oppose stricter AI regulation, how can the public be confident that a committee he co-chairs will provide an independent assessment of AI's economic effects rather than one aligned with the interests of the AI industry?
Yeah, so I selected 15 incredible subject matter experts to tackle 5 of the most important questions that if we get the answers right, we're going to do a far better job in delivering. And if we get the answers wrong, we have a problem. The comfort that I can give you and your listeners is we're the decision makers. The chairman of the board of the Federal Reserve and the members of the board and the FOMC, we will be the consumers of the outputs from 5 different committees. The judgments we're making will be informed by, but not at all determined by these outside groups. My theory of the case in establishing the task forces were to pick people with extraordinary talent, depth of expertise, and a divergence of views inside every committee, so they too can have a family fight. This is not outsourcing to people that aren't known and haven't been vetted. This is seeing whether new ideas can catalyze a broader, better, more informed discussion inside the room. And I'm very confident that we're going to be able to do that. I am impressed by the credentials of these 15 people. And full disclosure, I've known almost all of them for a very long time. And I think they're going to give their best views on the subject. But ultimately, these are decisions we're going to make, and we're accountable to our oversight committees and to the remit Congress gave us to deliver.
You know?
Hi,
I have some
Ann
thoughts.
Saphir with Reuters. Nice to see you again.
thoughts.
So I need a little help here too.
Yeah, me too,
You
bud.
said repeatedly you have no tolerance for inflation, and yet we are seeing above target inflation repeatedly for 5 years and through your term so far. And sure, you have no magic wand, but you have not taken action. You just gave us a little peek at your reaction function as well. You said that if underlying inflation is rising, that you would tend to
And it's rising.
think that you might need to tighten. And with
It's
the
rising.
exception of the most recent inflation print,
For
that is
5
what we've been
years.
seeing.
So what are you doing?
Could you explain what you mean by no tolerance
what are
for
you
inflation?
doing?
And
what is he even talking
you
about?
plan to do about it?
Sure. So, Ann, I hear from you what I hear more broadly from households and businesses: impatience. Deliver it already.
You just said 5 years of it. What do you mean impatience?
This is not an excuse. This is a fact.
It's an excuse.
This
It's
FOMC,
bullshit.
this board has been in business for 8.5 weeks. The patience, the impatience that households and businesses feel have been going on for 63 months.
The impatience
We
for
are
63
on the
months
job.
you've been impatient.
We will deliver. We are focused like a laser on making sure we can do it.
Dude, this is all getting real sus. I'm not gonna lie.
With our magic wand is one I want to disabuse you and everyone else of. But the discussion in the last 2 days give me more confidence even than I had 8.5 weeks ago. This team that we have at the FOMC, the support that we have from board staff, and the new hard questions we're asking, we need to resolve those. And as we resolve those questions, get smarter on those, we're going to deliver on the remit. You don't have to take my word for it. If you look broadly at market prices, they are certainly not saying all clear, but they are working in concert to keep us on our toes, and they have tightened financial conditions in this intra-meeting period. And that has given us, that has provided us some comfort that we've got the ability and capability to deliver.
And
What is he talking
your
about, though? He's like, he just-
read or your, I guess, faith in markets' ability to sort of make a judgment and then you to take signal from that judgment, how does that affect you when you come up on the September meeting and markets are seeing a near 100% chance of a rate hike as they see now? How does that feed into your decision making and your thinking?
So we're not going to be constrained by market prices. We're not going to be constrained or take verbatim from what the market's doing. But I think it's useful and to understand that markets can be a very good source of information. not a determinative source, not a perfect source. But if we're trying to land the plane and deliver 2% inflation,
we're going to start by
and
doing
we take
nothing.
A very useful source of information and we get it all fogged up.
We'll start with nothing.
By giving it our own forecasts, by providing rolling commentary. I can assure you that we're going to have less information, less ability to land the plane successfully and deliver price stability. We're just trying to make sure that that source of information is as direct and unfiltered as possible. It isn't to the exclusion of data sources and opinions and other surveys. But if you're hearing from me, we wanted to make sure we were getting a better source of information. I think in a relatively short time we are.
We'll go to Brian Chung for the last question.
Last question.
Hi, Chairman WARSH. Brian Chung with NBC News. So you said you'd be open to having press conferences when there's news to make. So today, no change to rates, no forward guidance. For the average household, I guess, what was the news today?
Tell him, Brian Chung.
So apparently it was news that I had a press conference. Let me just see if I can offer some clarity on that. Between now and year end, my predecessors and the Federal Reserve committed to press conferences this year. I'm committing to press conferences this year. That might be news to the people in this room and of no particular interest to your viewers and your readers back at home. What I can offer as assurance is that the Fed's on the case, that this Fed chairman feels better about this board and this committee's ability to deliver than I did when I showed up here on the first day. And I showed up pretty confident.
I'm glad that your feels are better,
I've been heartened by
glad
the reception that I
up.
received.
I'm glad the vibes
no
are
doubt
up.
in some of your commentaries today, you'll talk about a divided Federal Reserve. Well, that's not the feeling I felt the last couple of days and the couple of days
Vibes
before.
are up,
What
buddy.
I felt
Bullish.
was a group of professionals, all with different perspectives, different views, different judgments,
I feel so much better.
but eager to roll up their sleeves and have a family fight, and eager to
you're fighting?
reform the
Great.
way in which the Fed does policy, a keenness and open-mindedness and curiosity about that. So we have a far better chance to deliver on the remit that Congress gave us. And so I want to leave you with the optimism of a new central banker that we're committed as ever to deliver and to offer an assurance we will.
No
Thank you all
forward
very much.
guidance. Bullish on vibes. He's feeling good. What was this? What was this whole thing? What was this entire meeting? What did he say? He's the one who says, like, I don't want to do stuff. He's literally the dude who shows up and is like, I don't want to communicate when there's nothing to communicate. And you hear that and you're like, that makes sense. I like that, Warsh. That makes sense. Good. And then his shows up and says nothing. And it's not like he said nothing like a nothing burger from Powell. He showed up and he's definitively said things. He said inflation's been running away for 5 years. We are 100% committed to it. Don't make the mistake that we're not committed to it. People are making the mistake that they think maybe we're not committed to it. That the target maybe is different. No, but it's 2%, make no mistake. And then makes no change. Claiming, well, we haven't had a lot of time. We haven't had a lot of time to work on it. It's only been 8 weeks. Bro, the Fed is, a new chair doesn't mean like the Fed is different. Like all of a sudden, I don't know, like all of the Fed members reset and they don't remember anything. And like, what do you mean? What could you possibly be talking about? None of that made any sense. That one dude who pressed him and was like, well, you're saying inflation's up. You're saying you're committed to it. You're saying that you're going to use your tools available. You're not using your tools available. Why? And then he says it does nothing. That was crazy. I am starting to get a weird feeling. That was suspiciously weird. I don't know if any of you all caught that. The ChatGPT WARSH, but like that was suspiciously weird. The suspicious part to me, this gut feeling, and apparently that's all we were left with today is his gut feelings and his vibes, his general vibes. And I mean, I'm big on vibes, bro. I'm a big vibes guy. Don't get me wrong, I'm a big vibes guy. Love good vibes, loving the vibes are up. But not as much from my Fed chair. Not as much from my Fed chair. Crap, where was I? Oh yeah, the suspicious feeling. I was all but locked in today when we started this meeting saying we will have a September hike. If we don't have it today, we'll have a September hike. I think I'm still going to lean on that. Still going to like keep that as my official. But I have this strange taste in my mouth that I can't get rid of after listening to him. That strange taste, as some of you I think might have even said, is that it kind of sounds like he's committed to doing nothing this year. To just doing nothing. No hike, no changes, nothing. I worry that that's politically motivated. I do worry that that's politically motivated. I will say WARSH has not given me a reason yet to think he's politically motivated. But I do worry. It is. We heard Trump yell a lot about political motivation with Powell, which he absolutely wasn't politically motivated. If he was really politically motivated, he probably would have hiked interest rates like before he left. I wonder. Hopefully our thoughts and vibes are good enough. Dude, Brian Chung. 𝐂𝐴𝐺. Brian Chung, why are we here? What are you talking about? And his response was, well, I wanted to share the vibes. The vibes? The problem, so some of you are saying he's stupid or doesn't know what he's talking about. Or that's the problem, is he does know what he's talking about. And I don't think he's stupid. I don't think he's stupid at all. He knows what he's talking about, and he's not stupid. That's the problem. This is an intelligent person, an expert on this matter, who is leaving us with vibes. And I'm even more confident now, because you know how many times he said, like, infighting. Yeah, we fought a lot. We're doing a lot of fighting. What are you talking about? You know what he didn't do? He didn't release the dot plot again. He said that he would. He said he wouldn't be doing forward guidance. The dot plot is a forward guidance tool. But he said specifically that he would be doing the dot plot, but he wouldn't participate. That's fine. Who cares? We don't care. We don't care if he doesn't participate. That doesn't matter. But did you notice no dot plot update? There's 3 dissenting members today. 3 members said hike. That seems too low. Seems too low. It's weird. I do know one thing. I appreciate all of you tuning in today for the greatest and most important FOMC of our lives until September. Also, Bretton Woods in August, we'll cover that as well. But till September, tune in September, because I have no doubt that will be the most ridiculous thing we've ever seen. If today was any mention, any hint as to what the future holds, September could be very, very weird. Remember what happens when the Fed doesn't follow yields. You don't get a magical bull run. You don't get magic pumps in markets. Historically, that has been very bad news. I think we've seen, like, on average, a 10 to 20% correction in stocks when the Fed diverges. I got a lot to think about. Make sure you've subscribed to the channel, liked, followed along, turn your notifications on. Tune in Friday. We'll do a little more update. We'll have some time to brew on this. Make sure you sign up with our exchange partners in the video description below. We got FEMX and BYDFi. You can sign up using my link, regardless of where you are in the world. You can trade there. Great place to trade. Man, we got some thinking to do. Thankfully, the vibes are up. Your vibes are up. I love you all.